The thing I would emphasize is that there are bull markets and bear markets, and in essentially any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really discussing when we say, gold is up, what we're discussing is the dollar price of gold, and I perceive it as a cross-exchange rate. People discuss the dollar. There's a dollar gold exchange rate and the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. However, the first significant bull market was 1971 to 1980s. It lasted 9 years, and gold rose by 2,200%. The second substantial bull market was from 1999 to 2011. Gold increased, but just slightly under 700%. Nevertheless, between these periods, there was a bear market from 1980s to 1999, a lengthy one, almost 20 years, during which gold dropped from $800 to $250 at the bottom in 1999, and we experienced a second bear market starting in 2011. I had a very intriguing conversation with Jim Rogers. Jim is one of the great commodity traders, money managers of all times, and we were in the Dominican Republic at Acosta de Campai. This is around 2014, but the bear market began in 2011, but it really declined sharply in 2013. So I asked Jim, what do you think of gold? What are you doing? He goes, well, I own it, of course. And he said, I'm not selling, but I'm not buying right here. And he said something that just struck me forcefully and resonated with me. And of course, he's correct. He said, gold is going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900 approximately. And where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time. But if you look at that drop down and you use $250 as your base, because you need a base. So you had basically the run from $250 to $1,900 was $1,750. Go down 50% from there, it's $825. 1,900 minus 825 is 1,075. And the bottom is 1,050. Jim totally nailed the landing at 1,050. Like, okay, there's your 50% retracement. Now that's the bottom. Now it's going up and the sky's the limit. Well, we're not overheated at all. I've got gold at, I would estimate $15,000 an ounce before 2025. But as I point out, if you're going to $15,000 an ounce, you got to get to 3,000, 5,000, saying, so there's plenty of room to run, plenty of room for profits. But when I say things like that, I want to be clear there's a lot of analysis behind it. I don't just pull a big number out of the air for publicity because I could care less. But if you just took the average, and there are a couple of ways to think about it, just take the average of the two prior bull markets I mentioned. So 71 to 89 years, 2,200%, 99 to 2011, a 12-year bull market, about 700%. Just take the average. You don't have to go to the higher of the two or extrapolate. Just take the average of those two bull markets. You would say, okay, well, the next bull market is going to be a little over 10 years, and it's going to go up 1,500%. So using that as your base, just take the average of the two. You say, all right, 10 years in 2015, that puts you out to 2025, and at 1,400%, it puts you at an ounce off a base. So that's just history. But there are other ways to think about it. Now, I don't know if there'll be a gold standard or not, but I do know that gold will move. The price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed if you just took the money supply. So just take M1, which is pretty widely accepted definition of money supply. Take it for the US, the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less. You come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly, they come out in the same place. I don't think they have to. They're two different methods, but they both point to $15,000 an ounce sometime over the next 3 or 4 years. It is a moving target. The numbers I gave you were based on current levels, but you keep printing money, you need a higher price. If you want to reference gold and not cause deflation, which they don't, you're going to need a progressively higher price of gold. One thing people forget, they look at the dollar price in absolute dollar. So it went up $100 an ounce. Or I expect before long it'll go up $1,000 an ounce a week. But each dollar increase is a smaller percentage increase. So people look at the dollar, it's real money. It's nice to make the money, but if you go from $14,000 an ounce to $15,000 an ounce, that's only a 7% increase. You can do that in a week. So my point is, it's still $1,000 an ounce, good for the holders, but the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 1,112, it gets to be a progressively smaller percentage increase, and therefore more likely, you need to see it logarithmically to see it a less hyperbolic curve. So logarithmically is the right way to think about it. And when I say $15,000 down, I don't think I'm stretching.